Good afternoon, good morning, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Quickly on today's call, we've got Salih Yilmaz and Will Hares both calling in from Dubai, where it's already dark out. So thank you for staying a little bit late to bring some thoughts here to the table today. In London, we've got Patricio Alvarez and at 731 Lexington Avenue, we've got Fernando Valle joining us today. So that's the crew for today's call. We're always in the arena trying stuff. Some works, some doesn't, but always learning. And so on that front, if you haven't seen our React product, this is where we do the first version emergency room of analysis and try to take market moving information and shed some light on what it could mean for the companies and commodities that we cover. And today was a pretty big day for Orsted. Patricio, you put out a React early this morning. I'm not going to read it for everyone, but I will ask you to tell us what your React was about and how you see the tea leaves for Orsted and some of the other players in the industry at the moment.
Sure, thanks, Rob. Yeah, long story short, the React is was about or basically a reaction on Orsted booking of higher than anticipated impairment losses during the quarter. So the company had pre-announced it could record up to 16 billion kroner of impairments in the third quarter, stemming from the return pressure on projects in the U.S. So those were specifically three projects. Here today at results, the company announced impairments of 28 billion kroner, which is almost twice as much as what we expected. It also announced that it's pulling the plug on two projects in the U.S. That's Ocean Wind. It also flagged that there's still risk or there's still uncertainty over another three project awards in the US. So basically that takes almost all of their US exposure. It puts all of it at risk, basically, in our view. And that's kind of like the market reaction to that, is that the US growth chapter, it can be deferred or potentially abandoned. That's our view from the React, is that the offshore wind industry faces protracted headwinds, perhaps multi-year, especially in the US, where supply chains are more nascent relative to Europe, where the company's outlook is not as bad. As a result, we think the company will need to pivot, at least temporarily, until the offshore wind industry starts to recover towards the latter part of the decade. And we expect the company to perhaps pivot onto onshore wind here in Europe and solar, although that will obviously entail a revision of its project, of its targeted project returns, which is right now it's about 13%, but we expect that to trend down when the company announces its strategy update with the fourth quarter results. On top of that, I think that the other sort of lingering uncertainty is about the company's capital structure. So booking impairments of this size, and also accompanied by the cancellation fees, which are not insignificant at about 10 billion kroner, which is roughly 1.5 billion US dollars. That means that there will be a massive hole in the company's capital structure in the near term. And expectations are to see how can management deal with this hole via asset sales, with not really a lot on the pipelines in terms of new projects coming online. So yeah, we expect to see more news on a potential capital increase or a revision of the dividend policy at 4Q results as well. So it's been it's really a lot of moving pieces with Orsted today.
Okay, one of the things in your React that I was captivated by is this idea that are we reaching peak uncertainty for the offshore wind business, particularly in North America, or could there be more shoes to drop? And Will, I want to come to you to get your perspective, because as everyone on the call should know, but you cover BP and Equinor, who have also been active in the offshore wind space here in North America. So, it's how do you read it at this moment? Is there any read across from the problems that Orsted's been having?
Yeah, thanks, Rob. And the short answer is absolutely. And we just saw this yesterday in BP's results. They booked a $540 million impairment related to their US offshore wind projects, namely Beacon and Wind. And it's pretty clear that these pressures are going to extend. Some of the commentary surrounding these impairments from management signals to me that they are sort of playing with abandonment of it, or maybe you could read through that as a implied threat to abandon, to pressure regulators for renegotiation of their PPAs. But overall, the main theme coming out of these offshore wind impairments from BP is sort of underscored by their returns focus, in which they say that they are dead set on achieving their 6 to 8% project IRR for these across the renewables, and it's pretty clear that BP could not achieve that hurdle rate with the cost inflation, with where interest rates are, and with the and with where their previously negotiated PPA was.
Fernando, I know your companies aren't as active in the offshore wind space, but I know I always value your commentary when renewables come up. So we've often talked about this idea of a division in strategy between where the European majors are at versus the U.S. guys. So what do you make of the challenges that we've seen in offshore wind? Is this far afield from their core business in your perspective?
Yeah, I think certainly if you look at just the challenges that the operators had with oil or LNG, even building some of the floating LNG, or just even Barrow Island in Australia, it's hard to say that they're experts in building these large-scale offshore developments. You're not immune to cost inflation, as Will said, and certainly not to higher inflation rates, um, or interest rates rather. I think it will be difficult to see a recovery in offshore wind without significant cost inflation for the consumer on the power price. You can't make a return with today's interest rates. So you either have to get much lower interest rates or much higher power prices. Obviously, they are antithetical to each other. If you get much higher power prices, then rates are going to keep rising because that's a huge push on inflation. So I just don't see how that gets resolved. Similar, we've talked about rooftop solar as a problem because interest rates are so much higher that consumers are having trouble affording them. And how does that get resolved? Is it through higher power prices or through lower rates? And you can't really have them that they won't work in synchrony. So I think ultimately that just reinforces our view that you're going to need more natural gas, you're going to need more diesel, and especially today the EIA came out with numbers just at 10:30 in New York time, and the East Coast diesel inventory is so low and keeps getting depleted. It fell another 2 million barrels over the past week, and just reinforces our view for this winter. It could get really, really ugly in New England if we get a normal winter, let alone a cold winter. It did get pretty ugly last year with a very, very warm winter. So, hold your breath for what's to come in January, February, and March.
I will echo what you just said. For anyone that was on the SunPower call this morning, it's a tough world out there for anybody exposed on the residential side of the equation and solar. The opposite's quite true on the utility scale side. First Solar had a very interesting call last night. Pretty robust set of numbers with good margin, high growth trajectory, and seems like it's full steam ahead for at least some of the utility exposed solar names. But Salih, I want to switch gears and come over to you. Uh, Not because I think you want to answer this question, but it's on my mind. So just yesterday, I think Elon Musk was on Joe Rogan, and he started talking a little bit about this idea that, well, look, if we put solar everywhere, you can power the U.S. with a sort of something like 100 by 100 square miles of solar, which is a pretty big amount of solar, but it's a relatively small amount of land. Uh, I think the same kind of thing could apply in your region. You know, Saudi Arabia is the Saudi Arabia of solar as well as oil. But you know, what do you make of this renewables discussion? I don't think there's much offshore wind in your region, but there is some solar. And how does it fit in with the energy ecosystem that's already on the ground there?
Yeah, there isn't much wind here, and I think a lot of the focus has been, in terms of planning, has been very much on solar, not wind, just because there's plenty of sunshine here. It's abundant, it's predictable. So a lot of the renewable power generation planning has been around solar, but planning being the key word, because this region is still very much committed to the legacy oil and gas. They are increasing spending in other energy forms as well, but especially oil and gas. When you look at companies like Saudi Aramco, ADNOC in the region, they are still giving out massive contracts to increase their oil and gas production facilities. I mean, I think historically they've been very much focused on oil, but as Fernando said, I think natural gas being kind of the next growth market, they very much believe in that, and they are increasing they are investing heavily to be increasing their production capacity. So yeah, so I mean these issues that we've been talking about since the beginning of the call are not really quite as big of issues for these companies. But in terms of planning, I think they were planning more solar than wind anyway. So.
Okay, Salih, I think this is a good point to pivot and get a read on where some of the oil macro is at. Always a moving equation. We've had so much happening in the geopolitical arena over the last few weeks, and much of it concerning. But you know, what do you think on the oil side, and is there any read across for gas as well? Because I want to hit both.
So, I mean, the oil market to begin with seems to have shrugged off that geopolitical risk premium. I mean, oil prices are up about 2% today, but since the beginning of the week, they are down, and the Brent price is around $87 a barrel now, which is around the level before October 7. So, the oil market seems to be pricing essentially this conflict being contained in that Levant region, which is not really a oil producing nation, but there's obviously a lot of uncertainty around the conflict. We don't know what happens next, and I think perhaps there is definitely elevated geopolitical risk premium that the market seems to be ignoring now, especially because there really hasn't been any real impact on oil and gas production. And beyond that, I think the demand outlook for oil remains very bleak. I mean, we're getting very mixed data on, globally, US consumption has been surprising to the upside a little bit, actually, but then the China manufacturing data has been surprising to the downside. And these are moving, and it's just a very uncertain environment for demand, which looking just beyond next quarter, perhaps, and beyond this conflict, it looks like if demand stays as uncertain as it is now, it is very much possible that OPEC Plus and Saudi Arabia, with the voluntary cuts, may have to just keep extending beyond the end of the year, perhaps into the first quarter of the year, just to kind of combat that uncertainty in demand, which is clearly a big overhang. on oil prices.
Okay, Fernando, I want to come over get your read. I know you think about this deeply as well, and feel free to comment on Elon Musk 100 by 100 square mile claim. I feel like you've probably got a view on it.
Oh, absolutely. Like all of his physics claims, they are absolutely bonkers and don't account for transmission, don't account for degradation, don't account for storage, don't account for the fact that, you know, in Salih in Dubai, the soil is extremely silty. So one of the issues that they have with solar farms there, it's that you have to continually clean those panels so that you can keep production going. So it's a non-starter. Like it would never work. Like his boring company claims that it would never work either. It's all nonsensical. It's very, very shallow math on his 100 by 100 claim. You know, building on what Salih said, I'd say there's probably, in my end, I see a little bit more certainty on demand. It's bad. It's in the U.S. It's bad. Fuel demand is very, very bad, and has been since July. And then we've seen auto delinquencies up. Obviously, there was you know, there was some conflicting data with housing starts and new home sales, but I'm pretty sure that's just a lot of discounting, a lot of home builders trying to get off their inventory so you don't have to do an Orsted and write down, you know, 30% of their capital base, and recover some of their losses. But when you look at just where consumer saving rates are, household spending, it's all very, very low. You know, and the other aspect of it is that a fair amount of the spending has been done by U.S. Treasury, not by U.S. households. And what does U.S. government spending lead to? Inflation. What does inflation lead to? Higher rates. So we're still in this spiral of if the only spending is really government spending, it's leading to inflation. And then you're seeing mega projects like Orsted and BP and Equinor being canceled. All of that has an impact on our GDP and our productivity. So I think that the numbers are already showing massive cracks, and it won't get better from here, especially not if we have high oil prices. I mean, I think that there is geopolitical premium on the oil price today. It's just a matter of the demand is telling you we're not here for a $90 oil price. We just can't afford it in today's environment.
Will, I want to get some of your perspective on the oil market as well. What are you hearing from kind of the earnings cycle? And given you are in the heart of the Middle East right now, you know, what's your sense on kind of how folks in the region are thinking about this topic as well?
Yeah, so broadly strong set of 3Q earnings so far for European integrateds. The one exception has been BP, which I mentioned earlier from yesterday, which surprised the market to the downside, which also came against pretty strong oil realizations, a strong oil trading result, sharply higher refining margins in the period, and this was due to a very weak gas trading result. And as a reminder, the European integrateds have very large trading divisions, which have contributed meaningfully to earnings in recent quarters, and this we think is likely to extend this weakness in gas trading. For the Europeans, we've got very high, nearly full gas inventories in Europe, and low volatility was cited by management for some of this weakness in trading, and they didn't put a lot of risk onto the gas side as a result of that. And so far, the market structure, looking out across multiple months, it looks like it's going to be a similar situation again in 4Q on gas and maybe even oil as well. So I think the takeaway here is that because these Europeans do not specifically break out their their trading gains and losses, it has revealed the the scale of earnings contribution that these trading divisions have represented in some of the last quarters, and particularly through the first half of this year. BP's said that their gas trading division was exceptional for the first 2 quarters of this year, and this weak performance in 3Q has shown it to be pretty material, given a roughly $700 million miss on earnings. But otherwise, upstream looks pretty solid across the peer group. Oil realization should be pretty strong in fourth quarter, but another weakness, and which looks like it's coming through, is going to be on the refining margin side, with pretty high inventories and that sluggish demand growth. Keep in mind that the year end is the seasonal lows for demand for these refined products as well. So we expect weakness in downstream probably to materialize in 4Q for this group.
Well, just given the discussion on the gas side of the equation, I'd like to bring Patricio back on to share his thoughts on kind of where gas looks at the moment, particularly in Europe. We've had a roller coaster of 18 months or so here in gas. What do you think winter looks like, and are geopolitics playing into the gas price there as well?
Sure. So, I would like to echo part of Will's comments, tying it into the earnings reports that we've seen so far for the third quarter for our European utilities coverage. We've seen that upside from the gas trading and optimization arms sort of wane this third quarter. We've already expected this, and we've seen also a deterioration in energy demand in general, which keeps being very subdued here in Europe. And it's mainly a very strong first half for most of our companies that is sort of driving that inertia towards earnings growth this year. But we do see that sort of receding next year. In terms of gas prices, I definitely agree that there is a significant risk premium or geopolitical risk premium on European natural gas prices at the moment. Especially we've seen a relatively muted reaction to expectations of milder weather for the next 2 weeks, higher wind output because of the storms that are coming into the UK as well. So there are all these bearish signals. We are hitting our storage here in Europe is at an all-time high. It's more than 99% full at the moment. When the heating season usually, or the long-term norm for the heating season is to start at the 1st of October, we're almost we're at the beginning of November, and the heating season is starting now. So there are all these sort of bearish fundamentals in terms of demand, at least for gas, which would justify prices to be a little bit lower than where they are, or where they have been in the past few weeks, which is along the 50 euro per megawatt mark, versus the long-term norm, which is of around 20 euros per megawatt hour. We're not saying that should be the norm, because the region is exposed or overly exposed to a relatively tight LNG market, where any supply disruptions or sort of the looming threat of a supply disruption from the Middle East, from the conflict in the Middle East, could stoke price volatility. But if it does, we would not expect it to be to the levels that we saw last year, given that the share of LNG supply that could be at risk from disruptions in the Middle East is unlikely to be as large as what Europe's reliance on Russia was last year. So.
Okay, thank you, Patricio. Salih, I want to come back to you because I know that you and Will have a hard stop. So we haven't really had a chance for you to weigh in on the earnings cycle. So tell us, and what have you heard so far? What's your outlook for the companies in your coverage that haven't reported yet?
Yeah, so I would echo what's already been said. I mean, what I saw in some of the mid-size integrated names in Europe that I cover, pretty strong upstream realized pricing. In the case of Gulf, actually, they had pretty strong operational performance in their Brazilian assets. So pretty strong upstream. And then in downstream and in terms of refining margins, we did have a slump in the second quarter, but we did see refining margins recover in Europe in the third quarter. So refining was very supportive as well. So in the case of Repsol and Galp, it was a pretty good quarter for them. And this was represented in Repsol's surprise dividend hike, which we weren't expecting, and the beat in adjusted net income. And for Galp, this was represented in their guidance upgrade, which we were not expecting. But then in the case of OMV, this is a company that's becoming a little bit more exposed to chemicals, which continues to struggle a lot more than the other segments. I mean, the chemicals unit is generally very dependent on how well the economies are doing, and with the pressure on economies globally, chemical space and the chemicals margins have been under a lot of pressure. So we saw OMV not doing so well in the third quarter, and that was the reason for their earnings miss. But in the rest of the group's performance, again, upstream was pretty decent, probably will continue to be in the fourth quarter. Refining, as Will said, was a pretty good quarter for them in the third quarter, but they all seem to be expecting an easing of margins and performance in the fourth quarter.
Thank you, Salih. Will, I want to just get one last comment for you, which I think will be a good setup to move back over to Fernando. We've had this ongoing discussion about strategy differences, maybe differences around M&A. I think BP, as you've noted, they've denied any claims about interest in U.S. shale. But what do you make of all of the M&A activity from Chevron and Exxon? Are any of the European names that you look after likely to go on a buying spree as well? Or kind of how do you read the M&A trends?
Yeah, there's been a lot of rumors flying around, including a potential, Shell BP mega merger, which I think is incredibly unlikely, not least for antitrust issues and that sort of stuff. But overall, I can see that the rationale for M&A extending to Europe, but I just really struggle to see a similar legacy oil and gas trend to that, as we've seen from Exxon and Chevron, which have bought significant resource in Guyana and the unconventional plays in the U.S. And namely, this is because it would be completely counter to what all of these companies have been framing their strategies around longer term, and that is gradual and then accelerating emissions intensity reduction to hit net zero emissions ambitions by 2050. If they did make a material multi-billion or tens of billions acquisition in oil, it would almost certainly necessitate these targets to be abolished or at least significantly dialed back. And we have already seen an adjustment in some of these strategies, a slowing of their transition paces so far. BP, Shell, Total have all recently or within the last 9 months have dialed up their oil and gas investment. They're slowing their hydrocarbon production decline to the end of the decade. So we are already seeing a similar trend occurring in Europe. Just I don't think that it's going to come in the form of an extremely big acquisition like a Pioneer.
Okay. Thank you, Will. Thank you, Salih. If you guys have to run, we'll catch you on the next one of these. Just a quick advertisement since you mentioned net zero, Will. We've got a call in about half an hour if anyone's interested, where we're going to talk about the circular economy and the move to net zero. One of the things that the IEA and others have been kind of banging the drum about is that if you are going to move to net zero, that's going to imply quite a bit more demand for raw materials, and perhaps recycling and other things can help meet some of that. So we're going to have an in-depth discussion with Alon from our metals and mining team and a few external guests. If you can't find it on the SEMR page on the terminal, shoot me an IB. We're happy to tap you into that. And one other quick advertisement is just that next week, if you're in New York City, we're going to have an in-person roundtable. Fernando and I will be in the same room, so come join us. We've got a few other colleagues who are going to talk as well, and we're just going to have a broad discussion about the future of energy. And since we'll be at a table, we're going to solicit input from you as well. So it's not just listening to us. We want to hear what you think as well. So with that little bit of advertisement out of the way, Fernando, I want to come back around to you and just pick up on the theme that Will was talking about. What's your sense? Are we done with M&A activity in the U.S., or are we still going to see more deals coming in the kind of months and sort of quarters ahead as we look into 2024?
I think we've just kind of started because they've really, Exxon and Chevron have really ramped up the pressure on the independents to either get together or find a way out. They bought probably the two premier independent assets in global oil in Guyana and Pioneer in the Permian. If you look at who else is in this Stabroek block, it's CNOOC. They're not going to sell their stake. You're not going to buy CNOOC either. If you look at the Permian, there are a couple other players, but they're all a step down after Pioneer. You could buy an Endeavor, you could buy a Crown Quest, as ConocoPhillips is being rumored to buy. But there is still consolidation to be had there. It's just not in the scale and quality of Pioneer. We think that some of the medium public independents may either look to these private companies like Endeavor, Crown Quest, etc., or to themselves. There have been talks with Marathon Oil, Devon, others also looking at consolidation as a potential opportunity. Ultimately, you need both breadth to lower your cost of capital, but also to make sure that you can have the strength to negotiate with suppliers and you're not put last in line after Exxon, Chevron, Conoco, Oxy get all the resources. So be on the lookout. We think there's more consolidation happening, probably not being driven by Exxon and Chevron, but by others, especially on the U.S. side. I think, as Will said, seems unlikely that BP and Shell are going to be major movers. Just as a reminder that Shell sold their Permian acreage to ConocoPhillips. BP bought BHP Billiton's shale acreage, and there's been rumors recently that they're looking for joint ventures in shale, but they're not necessarily going to be huge acquirers. Their CEO left shortly. Their shale CEO left shortly after their overall CEO left. So they're still in a bit of a transition.
Thank you, Fernando. Patricio, let me swing back around to you for the last comment on this M&A topic. I think many of your companies are focused on organic growth, and so they're developing their own projects. But do you see M&A as a possibility in the utility space right now, or is this going to be limited to oil and gas?
I think short answer is no. There's just not nearly as much cash available in the utility space for large ticket M&A. M&A activity year to date has been very much subdued in our space, and the few deals that we've seen are just mainly minor stake sales in operational projects or projects that are about to come online. That are just congruent with asset rotation plans, so mainly to try and sort of recycle capital and shore up the company's balance sheets. But beyond RWE's acquisition in the U.S., which was significant for the size of our companies, they acquired about 3 gigawatts of solar in the U.S. And for a company that size, it was quite important. Beyond that deal, there hasn't really been a major M&A in the utility space, and we expect actually to continue to see this sort of slowdown relative to historical to historical levels, and that does flag a risk, at least for in our view for renewables, because renewable developers are very much reliant on capturing solid transaction multiples on those deals, and so far they've been sustained and in line with the history, but we do see this higher for longer interest rate conditions hurting those multiples in the near future.
Okay, thank you very much, Patricio. Just on that note, a quick announcement. We've got a very active chat, client chat that many of you participate in. We are going to soon be launching one that's got more of a energy transition, clean energy utility focus for the folks who really want to go deeper on that. So Patricio and I will both be helping to spearhead that. So if you're interested, let us know. We'll make sure you get included on what's going on there. And again, if you're in New York, come join us 1 week from today. And lastly, I'd just say we do these weekly now, just so that we can get more broader perspective from not just the folks who are on the call today, but some of our other US and global colleagues. So make sure that you tune in for these on a weekly basis now. If you want to be included on the invite so you get a reminder, just let any one of us on the call know. We'll make sure you get added to our distribution list, and look forward to being in touch. As always, we're green dots on the terminal right now, so just ping us if you have any follow-up questions. Take care, everyone, and I hope you have a great rest of your week.